All right, let's dive into this one. You sent over this article from the Motley Fool, 3 reasons Pfizer stock could be a steal of a deal in 2025. Seems like you're trying to figure out it's worth taking a serious look at as an investment, right?
Yeah, you got it. It definitely caught your attention, and I mean, it lays out a pretty bold claim right there in the title.
Well, let's say those 3 reasons hold up. We've got the article by David Jagielski here, published March 20th, 2025, so it's fairly recent.
Yeah, fresh off the press.
Okay, so first things first, what's the overall argument? What's the big picture here?
Well, Jagielski's basically saying that Pfizer might be significantly undervalued right now, and he points to 3 main factors to support that claim: the valuation, the dividend, and the company's acquisition strategy.
Okay, I'm with you. Let's break those down one by one. Starting with the valuation, the article highlights Pfizer's low forward price-to-earnings multiple, or PE. Currently, it's sitting under 9, which is quite a bit lower than the average for the healthcare sector.
Yeah, like way lower. The Healthcare Select Sector SPDR fund, which is kind of a benchmark for the sector, has an average forward PE of almost 18.
Almost double. So how do we make sense of that difference?
Well, the first thing to consider, and the article does acknowledge this, is the looming patent cliff that Pfizer is facing. Some of their big moneymaker drugs are going to lose patent protection soon, and that obviously introduces a lot of uncertainty about future revenue. Investors tend to get skittish when they see that kind of uncertainty on the horizon, so that could be part of the reason for the low PE. But, that begs the question, is the market overreacting? Is the discount too steep?
Yeah, good point. And to that point, the article does bring up Pfizer's own 2025 revenue projections, which are between $61 billion and $64 billion. That's not drastically lower than their 2024 revenue of $63.6 billion.
Right. So while there is an expected dip, it's not like they're forecasting a massive drop-off. That suggests their existing portfolio and newer products are at least somewhat mitigating those patent losses.
I see. So there's a degree of stability there.
Exactly. And here's another thing to keep in mind, especially if you're thinking long-term. Pfizer is still pouring money into research and development. They're not just sitting back and letting the patent cliff take them down.
That's a good sign, yeah. A low PE can sometimes indicate a company that's basically on its way out with no real growth prospects, but it sounds like that's not the case here.
Not at all. They're actively trying to develop the next generation of blockbuster drugs. So when you put it all together, the relatively stable revenue projections, the ongoing investment in R&D, that low PE starts to look pretty tempting, especially for someone like you who's always on the lookout for potential value plays.
Makes sense. Okay, so that's the valuation argument. Let's move on to the second reason highlighted in the article. The dividend. Pfizer is currently offering a yield of 6.7%, which is huge compared to the S&P 500 average of just 1.4%.
Yeah, that's a pretty massive difference. I mean, that kind of yield can be a big draw for investors, particularly in a market that feels a little uncertain, which is kind of what we're seeing in 2025. The article even mentions the ongoing trade tensions with China thanks to President Trump's policies.
Right, those tariffs are still causing headaches. So in that kind of environment, I can definitely see the appeal of a hefty dividend. It's like a steady stream of income no matter what the market's doing.
Exactly. It provides some downside protection. You're getting paid to hold the stock regardless of short-term price fluctuations.
Okay, but with such a high yield, the question is always, can they keep it up? Are they actually generating enough cash to support those payouts?
That's the million-dollar question, right? And the article does address this directly. They point out that Pfizer's free cash flow in 2024 was $9.8 billion, which is more than the $9.5 billion they paid out in dividends.
Oh, so they're covered.
Yeah, they've got a decent cushion there. It suggests that the dividend isn't being funded by smoke and mirrors. It's coming from actual profits.
So it seems sustainable, at least for now.
Right, and that's important because if a company is struggling to maintain its dividend, that can be a red flag. But in Pfizer's case, it seems more like they're simply sharing their profits with shareholders. For someone like you who appreciates a mix of potential growth and a solid income stream, that high dividend yield could be a major plus.
All right, let's talk about the third reason, Pfizer's acquisition strategy. They've set a pretty ambitious goal of adding $25 billion to their top line by 2030, primarily through acquisitions and their internal drug development pipeline.
Yeah, they're not messing around. And what's interesting is that they've already made significant progress towards that goal.
Really?
Yep. CEO Albert Bourla has said they've already added about $20 billion. A big chunk of that came from their acquisition of Seagen, the oncology company, back in 2023.
Ah, that was a big one. So it seems like they're putting their money where their mouth is.
Absolutely. And it looks like their acquisition strategy might be evolving as well. The article suggests that while another massive deal like Segan might not be on the immediate horizon, they're now focusing on more strategic, targeted acquisitions.
What does that mean exactly?
Well, instead of just going after the biggest companies they can find, they're being more selective. They're looking for companies that can specifically fill gaps in their research pipeline or bring in promising drugs in key therapeutic areas.
So it's less about just adding bulk and more about adding the right kind of assets.
Exactly. It's a smarter, more focused approach. And these smaller, more strategic acquisitions can have a couple of beneficial effects. First, they can bring in potential blockbuster drugs that can help offset those future patent losses we talked about earlier. Second, they can signal to the market that Pfizer is serious about addressing its long-term growth challenges, which can boost investor confidence and potentially lead to a higher stock price.
Okay, so those strategic acquisitions are definitely something to watch. Now, towards the end of the article, Jagielski does inject a dose of realism. He points out that Pfizer's stock has been trading at a discount for a while now, and a major rally might not happen overnight.
Right. He's basically saying, don't expect to get rich quick. Patience is key here.
Which is often the case with value investing, right?
Absolutely. The article's argument is that the underlying fundamentals, the stable financials, the acquisitions that are already adding to the top line, and the potential of their drug development pipeline all suggest that the market is currently undervaluing Pfizer. But it might take some time for that value to be fully recognized. For long-term investors like you, that emphasis on patience shouldn't be a deterrent. It's just part of the game.
All right, so let's recap. This deep dive into the Motley Fool's analysis has highlighted 3 key reasons why Pfizer might be an attractive investment right now: the low PE ratio, the substantial dividend, and the active acquisition strategy. The article suggests that these factors, combined with Pfizer's commitment to research and development, point to a company that's poised for future growth, despite the challenges they're facing.
And if you step back and look at the bigger picture, the article is essentially arguing that the market's current skepticism about Pfizer has created an opportunity for savvy investors who are willing to take a longer-term perspective.
Interesting. Now, reflecting on all of this, what stands out to you the most? What are your key takeaways, and what aspects of Pfizer's situation, or maybe the broader market conditions, do you find particularly compelling or concerning?
Well, for me, the key is how these factors align with your individual investment goals and risk tolerance. This deep dive has provided a great overview, but further research into Pfizer's specific drug pipeline, their acquisition targets, and the overall healthcare landscape would be crucial before making any decisions.
Great point. Always do your own homework, folks.
Absolutely. This article offers a compelling narrative, but it's just one piece of the puzzle.
That's right. Always look at the full picture. All right, that wraps up our deep dive into Pfizer. Thanks for listening.
As always, it's been a pleasure.